Hi everyone, my name is Karan and welcome to Karan's Gyan. Today I'd be talking about forwards. So forwards is important for you because it helps you understand the derivative market which comprises of futures and options, because whoever enters the stock market always wonders what are futures and what are options. Why do analysts keep recommending you to buy a certain future or a certain option? And how are futures and options different from shares? So, for you to understand futures and options, I'll start with forwards. Forwards is a building block for derivatives. It'll give you a better understanding on how to approach concepts of futures and options. Alright, so I'll give you a brief introduction about forwards. Forward is basically forward price. What do you mean by forward price? Forward price is the price of a certain commodity, a certain time frame ahead. For example, if I ask you, what do you think is the price of rice 3 months from now? You would come up with some basic calculation about how much supply of rice should be 3 months from now, what be the demand of rice 3 months from now, and you'll say, all right, I think 3 months from now rice might be 40 rupees a kg. You might be right, you might be wrong. If you're right, well, you're a genius. But what do you do if you're wrong? Well, that's where forward comes in. Forward prices are used to fix the price of a commodity after a certain duration of time. So you can come into an agreement with the party, or you can come into an agreement with the seller saying, all right, I am growing rice. My rice should be harvested 3 months from now, and we don't know what the price would be 3 months from now. It might be more, it might be less. So why don't we reach a middle ground and confirm the price of rice to be 30 rupees kg? So I'll harvest all my rice and I'll come up to you and I'll sell you all my rice for 30 rupees a kg, irrespective of what the price of rice would be then. So this is a forwards price. This is a forwards market. It is the price of a commodity in future. All right. So, like I said, it was primarily started to protect the interest of farmers from adverse price movements. In a forward market, the buyer and seller would enter into an agreement to exchange the goods for cash. The exchange would happen at a specific price on a specific date. So, like I said, specific price in the example which I gave you is 30 rupees, and specific future date is 3 months from now. So the price is agreed upon by both the parties. Both the parties would agree, all right, 30 rupees a kg 3 months from now, and they agree upon the date and how the rice should be delivered, etc. etc. Also, another criteria which I haven't written here, they also agree upon the quality of the product. So, for example, rice has a lot of different varieties and a lot of different grades. So, they might come up to an understanding of delivery of basmati rice and K3 grade of basmati rice. So I'd give you a more detailed example. We say there are two parties, ABC Jewelers and XYZ Gold Dealers. Alright. So they come into an agreement on 1st January where XYZ Gold Dealer would sell gold to ABC Jewelers at a specific time in future. Mind you, today's 1st January and the price right now is rupees 2450 rupees per gram. And these two participants have come up into an agreement about delivery of gold some duration from now. Alright. So the situation is ABC would need 1 kg of gold in 3 months of time. So ABC would come up with an agreement with XYZ gold dealers to give to buy gold from them 3 months from now. That means January, February, March, April. That means they would buy 1 kg of gold from them on 1st April, which is 3 months from now. They haven't agreed upon a price. So in this case, let us assume they agree upon today's price. Uh, 3 months from now, so they say, all right, ABC says, all right, I'll buy 1 kg of gold from you 3 months from now, all right, at rupees 2450 rupees. All right. So you would ask me, all right, if he wants to buy gold 3 months from now, why doesn't he buy gold today at the same price, 2450 rupees? ABC Jewelers might have certain problems. Maybe they don't have that amount of cash available right now, and maybe they're expecting orders to be picked up later today, so they don't think it's beneficial to buy gold right now. So, anyways, and this they might have some XYZ problem. Moving on, they also think that since they can't afford to buy the gold right now, they'll be buying gold 3 months from now. They don't want to lose out if the gold price increases drastically, because as you know, gold price fluctuates every single day, every single minute, every single second. So they don't want to miss out because of higher gold prices. So they have come into a agreement with XYZ gold dealers. Okay, so I'll repeat again. The agreement is, uh, they'll buy, ABC Jewelers would buy 1 kg of gold from XYZ gold dealers on 1st April at rupees 2450 rupees a gram, 1 kg gold. And as I've told you, there is a quality criteria also, which is 999 purity, which is the highest available purity you can commercially buy. Okay, moving on. So now they've come into a contract. ABC would buy 1 kg of gold on 1st April at the rate rupees 2450 rupees a gram. So 1st January is over very fast, and 1st April has come. So on 1st April, there are three possible scenarios. First, gold is more than 2450 rupees per gram. Gold is less than 2450 rupees per gram. And third scenario is gold hasn't changed at all. Alright, so let us try to demystify. Hmm. So on 1st April, alright, 1st April has come. Huh. So ABC Jewelers, the price of gold is more than 2450 rupees. It is 2700 rupees per gram. And so now they have come into an agreement. The agreement has to stand. So on 1st April, XYZ gold dealers has to sell 1 kg of gold to ABC gold dealers, ABC jewelers at 2450 rupees per gram, irrespective of what the market price is, which in this case is 2700 rupees per gram. As a result, ABC has saved 250 rupees per gram, earning a total of 2.5 lakh rupees per gram. And as a result, since the market rate is 2700 rupees and XYZ gold dealers promise to sell gold at 2450 rupees to ABC jewelers, they'll incur a loss of 2 lakh 50,000 rupees. Scenario 2, gold prices have fallen. Now, ABC Jewelers is obligated to buy gold from XYZ gold dealers at a surplus price, which in this case is the price which they agreed upon on 1st January in the forwards contract. Alright. the price was 2450 rupees. However, current market price is going on as 2050 rupees. As a result, they'll have a loss of 400 rupees per gram, which incurs a total loss of 4 lakh rupees. Whereas gold dealers, XYZ gold dealer has a profit of 4 lakh rupees because he has sold gold which is worth 2050 rupees at 2450 rupees. Yeah. Scenario number 3, there is no profit, no loss. Yeah. Now, for you to get a better idea, I made a graph. The graph shows profit of ABC Jewelers. So the profit of ABC Jewelers is mm, so so the question is, what is the point of getting into a forward contract? You know, what is the point of it? Why did ABC Jewelers get into a forward contract with XYZ gold dealers when they can, face loss, so they can face profit? So ABC wants to get a price protection against rising gold prices. It wants to protect itself from the fluctuation of gold prices. It wants to mitigate the market risk it has, you know. So it doesn't want to lose out if gold price increases. Whereas whereas XYZ gold dealers, they want to mitigate inventory risk. Now what I mean by inventory risk? Inventory risk is when you have gold and in as inventory with you, which is supposed to be sold out in the future. Now you bought gold at a certain price, and if in the future the gold price drops, you have a risk. It is a risk because you have gold which you bought at a higher price. It is there in your inventory, but it's again a risk because gold price can increase or decrease. So you want to try to mitigate your inventory risk. So so you try to look at this. ABC Jewelers fears that its gold price, it will have to buy gold price at a higher price 3 months from now. XYZ fears it will have to sell gold at a lower price from now. It fears market risk. ABC fears market risk. XYZ fears inventory risk. It fears the inventory which it holds might decrease in value in the future. As a result, both of them would enter into a contract. Alright, both are trying to, couple their risks out by entering into a contract. Alright, so now first April has come, XYZ and ABC, both these companies, ABC Jewelers has bought 1 kg of gold from XYZ gold dealers. Alright, so how can they settle their positions? Either ABC Jewelers goes and directly collects 1 kg of gold by paying 2450 rupees a gram, which was the agreed upon price of the futures contract they came into on 1st January. All right. Otherwise, if ABC Jewelers feels that if it hasn't gotten the demand it was expecting that it required, or maybe ABC feels that it doesn't need the 1 kg gold because it doesn't have the clients it was expecting 3 months ago, so they can say, all right, I don't think I need the gold, but still there's a price difference between the price we agreed to and the current market price, so they can come up to a cash settlement, which can be paying the cash difference between current price and forward price. For example, here, instead of ABC Jewelers buying in this scenario, in scenario 1, when gold price has increased to 2700 rupees, instead of ABC buying 1 kg gold from XYZ gold dealers, they can say, all right, I think so, I didn't expect that much demand, and I think I don't need the 1 kg gold. I am happy with whatever gold I have, and that is enough for me to give my clients what they want. So why don't we settle in cash instead of me buying 1 kg gold at a discount price? Why don't you give me 2,50,000 rupees and we close the deal? You know, similarly, there can be a cash settlement in which XYZ gold dealers can ask ABC jewelers to pay them 4 lakh rupees as a cash settlement instead of physical settlement. So, physical settlement is settlement of the commodity. Like I told you, forward contracts are based on commodities. So, if there's a forward contract of rice, the physical settlement would be delivery of rice. In this case, the physical settlement is delivery of gold. Cash settlement is paying the difference, as I told you. All right. Now, forwards, as good as it sounds, has a lot of disadvantages. I mean, it does have good number of advantages, but I feel the disadvantages outweigh its advantages. So there are four big disadvantages. First is default risk or counterparty risk. So this may sound intuitive enough. Default risk is ABC Jeweler says to XYZ gold dealers, listen, I'm bankrupt. I got no cash to give you. Alright, I know I owe you some amount of money. Now, for example, if it's scenario 2, so they owe XYZ gold dealers 4 lakh rupees, and they say, listen, I'm bankrupt. I don't think my business has picked up as much I expected. Sorry, I can't abide by the contract. End of story. XYZ gold dealers can take them to court saying they didn't they didn't agree to the agreement, they didn't follow the agreement, but that's it, it's over. All right, they'll have to go meet the bankruptcy court, legal proceedings, or someone else, and they'll have to try to resolve this out. But it's still a risk. All right, it's a default risk. It's a counterparty risk where the other party refuses to, like obey the contract. And that is one of the biggest disadvantages. Second is liquidity risk. Now, in this case, you know that XYZ and ABC Gold, XYZ gold dealers and ABC jewelers, they already knew each other. They already have done business with each other. So they know that XYZ gold dealers, they are willing to agree, come into a forward contract, and they can directly deal with them. But at times, ABC jewelers would have to go to a bank and tell them, see, I want to make a forward contract with someone. I'll be willing to buy 1 kg of gold at 2,450 rupees 3 months from now from someone. So why don't you, find someone and I can pay you commission based on it. So bank is kind of incentivized to go and find a person who can come into agreement with ABC jewelers. All right, so that is liquidity risk. So liquidity risk is basically there is a cost, like there's a third party in between who would want, cut off earnings. So that is liquidity risk. Next is regulatory risk. Regulatory risk is again related to the first point. There is no regulation, there's no third party in between, there's no negotiator who would come into the picture and who would kind of certify the deal. So if any of the parties defaults, says no, sorry, I can't do the deal, there's no regulatory body to regulate such an agreement. So there needs to be a regulatory body, and even that is a big disadvantage. And fourth is rigidity. So this contract is very rigid in the sense that since ABC Jewelers got into a 3-month forward contract with XYZ gold dealers, ABC Jewelers can't break the contract. It can't break the contract midway. After 1 month, it can't change its mind and say, "Oh, I'm sorry. I think I don't need the 1 kg gold. 3 months from now, I made a mistake. and it can't back out from the contract, so it's very rigid. So it's extremely rigid, and that is a problem. You can't break the agreement. So again, as a result, rigidity contributes to default risk and counterparty risk. So that's it, guys. This is forwards market. I have this PDF file available to me, like available. If you guys want a copy, I can share it with you. If you guys like the video, please press the like button. If you like my channel and you want more videos, subscribe to my channel. And if you have any doubts or if you want to give your feedback, please comment. Thank you very much.